Well, hey, welcome back. I'm Chris Stallings, Wealth Advisor here at Abundance. I'm joined again by Casey Hazen, Senior Portfolio Strategist with Horizon, who helps us co-create all the models that we manage for our clientele. And so, just reviewing what's been happening so far this year, specifically going over second quarter results and things like that, things we've been seeing. I've been noticing a pretty good tailwind as it relates to people using artificial intelligence. We've been talking about that adoption rate for, it feels like the last couple of years now, and how that adoption rate is at a higher pace than what we saw the adoption of the usage of personal computers and internet and things like that. So that can bring a great deal of productivity and hopefully some efficiency and some margins can get better. But Casey, what are you guys seeing over there as it relates to artificial intelligence?
Yeah, that is definitely a very good place to start this kind of market review and outlook. AI is something that everybody is obviously talking about it. You and I have been talking about it now for the past right around 2 years. And to your point, it is starting to be more widely adopted, not only within niche industries like technology, but pretty much across all different industries and sectors within our economy. Everything from legal companies are really starting to take notice of this. Operations, sales, marketing, it obviously makes a lot of sense there as well. But obviously, even here at Horizon, within our investment management process, it really does support some of our analysts with their research efforts. So we've seen a big tick up in adoption, and that's led to really a big tick up in productivity, at the individual company level, but also at the economic level. And this is a trend that has been very, very exciting, that's been going on really since the advent of, the internet or,
Mhm.
PCs becoming more prevalent within the workplace. Prior to that, prior to the early mid 90s, we were in this industrial period where you can see profitability. This is looking at, aggregate corporate profit margins.
Mhm.
They kind of hovered right around, that 6% rate, kind of fluctuating higher or lower depending on kind of the current economic cycle we were in. But since then, since again, this new technology, this new innovative technology, we've seen profit margins just kind of steadily increase over the past 20 plus years. And this is where we're most excited about AI taking us, is going forward, seeing productivity continue to increase and just kind of allowing companies to do more with less. That's really at the end of the day what AI is providing right now. And that's really a huge tailwind, not only for the economy, but for markets and for the investments that we hold in these portfolios.
Yeah, that's it's interesting. There's so much speculation about how AI will impact the labor force, and I think there's no doubt that that will provide challenges in the future. But right now, it seems like it's creating efficiencies and profitability for publicly traded companies, so that helps the markets move higher, right? So,
Yeah, absolutely.
yeah, this is a great picture that you showed about the fluctuations of profit margins through the last what 70 maybe 80 years there. So, and I can only assume that we'll see a greater increase in productivity with AI over even what technology, based on that trend that we're seeing right there. So that's great. Appreciate that, Casey. So I
Um,
think the next piece was we were going to get into some of the consumer sentiment next, right? We had talked about that last quarter about how that was falling, but you guys have a an added detail, I think this time that I think is important to be able to show everyone. Not
yeah,
not a surprise, but it tells you beyond what the tea leaves are telling you. It's like let's scratch below the surface and see what else is going on. So yeah, this was the chart that we had looked at recently
yeah,
about how consumer sentiment's falling off. And just
exactly.
for the new people, I know we talked about it last quarter, but the University of Michigan um, consumer sentiment evaluation has been an important gauge um, of the economy or individuals' sentiment for how long, Casey? I mean, I remember using it when I was a rookie broker at Morgan Stanley in 2000. So yeah, this chart goes back into the 90s. So forever, this has been a great gauge, but I think there's more happening here below the surface.
Yeah, very much. There's this kind of dichotomy going on within the economy right now where you have how people are feeling is very,
Mm,
very different from, the underlying actual data that's being reported on the economy. And
right.
so these next couple of charts are going to be talking more about how people are feeling, right? And as this chart shows, the feelings right now for average consumers have definitely taken a turn lower.
Yep.
Again, this chart here specifically looks at, or it's a survey asking people, do you think you're going to be in a better financial situation next year? Yes or no. Basically, anything below the kind of the zero line here means that more people think that they'll be worse off. And that's
Mhm.
very rare, right, for the US consumer. Historically, very, very positive. Even in periods like 2008, 2009, during the Great Financial Crisis, that only barely ticked negative on aggregate. And you can see where we currently sit right now over the last couple of months, especially around all the uncertainty with these tariffs. Consumer sentiment has taken a massive turn lower, a lot of pessimism currently. And that's concerning, right? From like a leading economic indicator. If you're asking a consumer if they think they'll be making less money next year, they'll be in a worse financial situation. In all likelihood, what that should indicate to you is that they're going to spend less money, they're going to hunker down, they're going to save a little bit more to try to weather the storm. That's definitely a negative forward-looking economic indicator. And I'm sure you're seeing a
Yep.
lot of that pop up in headlines. And that is definitely a concern that we're looking at. But it's definitely worth pointing out, or at least caveating, a lot of these sentiment readings that we're seeing
Hmm.
with, how politicized everything is right now. Right. This is a chart
Yes.
that's basically, same University of Michigan survey, but this one's asking, if like, do you identify as a Republican or do you identify as a Democrat? And then asking those people, do you expect inflation? Like, where do you expect inflation to be 1 year from now? And you can see there's a massive difference between,
Yep.
Republicans and Democrats. And so I think a lot of this politicized feelings right now is they're definitely at extremes. And so
Yep.
it is definitely warping a lot of these survey results, these sentiment indicators that we're seeing. So for us, it's one of those things where we just think that with all of these surveys that you're seeing, you do need to take them with a pretty massive grain of salt, at least from what we're looking at.
Yeah. No. This chart when I was going through the review was so significant to me because without this detail, that University of Michigan review was really impactful. I was an inflection point, and in the end, we have a little bit of an uptick. Even that maybe is positive. But and I've seen it across clientele when I'm having reviews towards more conservative Republican types, they're raving about their new president and the people who didn't vote for Orange Man bad, like they are, and rightfully so in some cases. I have had people very close to me impacted by some of the changes to the government, back to work type things, or even funding. So maybe in some ways, I rightfully so, right? I can see why they would be feeling the way they do. But at the same time, what I'm noticing is that wages are going up. People are making more money. And whether they like it or not, they're going to look at their checking account and realize they have got cash laying around. So, and they tend to spend that, not save it. Maybe not on the big projects necessarily. They might play closer to the vest. I've got contractors who are in construction saying that things have slowed down a little bit for some of them. But some of your consumer things or your typical trips you might take, which might tee up our next slide, are unchanged. So
Yeah.
if as long as people keep spending money, things should continue to fare pretty well.
Yeah, exactly. While, many questions within these surveys that are being asked, we feel like they can be politicized. We tried to find a survey question that was about as apolitical as possible. And that's
Yes.
this one that we found around vacation plans. Do you plan on taking a vacation this year? About as apolitical as you can possibly find. And it
Hmm.
does tell, I would say, a slightly different story, right? Where, it's not overly negative. It's not, as dour as we saw back in 2008, 2009, or, especially around COVID. Obviously, that was a very hectic time to try to take a vacation, there has been a little bit of a downturn, but still roughly in line with kind of some of these longer term averages. So I think this is a little bit better of a overall sentiment indicator from what we're looking at. Again, not as drastically negative as that first University of
Yeah.
Michigan survey that we showed.
Yeah. No, I agree. That seems more reasonable. And I don't know how much more apolitical you can get than are you taking a vacation this summer?
Yep.
So yeah, but all right. So coming up next, I think we're going to get into some equity market valuations, correct?
Um, so when we were talking about a lot of those sentiment survey reports, again, a lot of that is going to be the soft economic data. When
Okay.
looking at kind of hard economic data or things like this, that's looking at GDP, again, this
Hmm.
kind of points to a little bit different of a story where, again, this is looking at nominal GDP growth here in the US. And again, over the last couple of years, things have definitely slowed down. We were coming off pretty extreme highs, after
Yeah.
COVID, where we saw obviously massive GDP kind of, deceleration or contraction. And then we had obviously a surge in growth there. And we've been trending lower over the last couple of years. But again, we are not to this point where GDP is falling off a cliff or it's
Right.
drastically negative or the economy is in shambles. We're really kind of in this fairly healthy 5%, nominal GDP growth range. And we can look at other hard economic data that tells a very similar story. So this is looking at corporate revenues. Again, coming off of some of the highs that we've seen over the last couple of years, but still very, very healthy, growing at around 5% year over year. Healthy corporate revenue growth is important because, and you mentioned this earlier, Chris, the labor market is obviously very dependent on companies continuing to be profitable, continuing to make more money. And the labor market is probably the most important economic indicator in determining whether an economy is healthy or not. And so that's what this chart here on the right-hand side tries to look at. So the Kansas City Fed puts together this labor market conditions index, which is basically an aggregate a lot of different labor market indicators. So things like the unemployment rate obviously is important there, but also what's the hiring rate? What does wage growth look like? What do layoffs look like? So a little bit more all-encompassing of a look at the overall US labor market. And again, similar story, cooling down, not as strong as it was back in 2022, but still green, still roughly positive. So again, for us, this all points to, an economy that's not roaring, but it's also not, again, falling off a cliff or, very, very negative. I think our CIO said we're in a 6 out of 10 economy. We're not in an 8 or a 9 out of 10 economy like maybe we were a couple of years ago, but we're also not a 2 out of 10 economy like, some headlines might make you think. So I think, this title up here, chugging along, I think is a very adept word to use for how the economy is right now.
Yeah, no, I agree. It seems like we're not, full steam ahead, but we are still moving forward, and that progress I think is necessary. It seems like some of what's happened has helped stave off even some recessions, and it seems like, every time we turn around, the sky doesn't seem to be falling, at least not yet, right? So, but from the previous three slides you showed, it seems like a lot of the valuations may not be as hot, but they are normalizing, and that we've had some fantastic experience, whether it's in the economy or the stock market, when those valuations have been at these levels in the past. So it may not be a 30% return in the S&P 500, but it does mean that there's hopefully some opportunity to make some money in the meantime with things
Yep.
persisting the way they are.
Yeah. And yeah, I think it's a good transition point to kind of take a look back at this year so far, at least through the first half of 2025. And it is kind of a tale of two stories, right? The first quarter, we saw a pretty negatively trending, stock market, especially here in the S&P 500. And then the second half, or the second quarter of 2025, we started with Liberation Day, and there was a huge panic and sell off. And then we did get a pretty significant relief rally on the heels of the president pushing back some of the deadlines, 90 days. And what this chart here, I think, is really interesting, and I think this does tell the story of what's happened, at least in the first half of this year. The market has been trading on uncertainty. Um, and so Bloomberg puts together this global trade policy uncertainty index. So obviously that has to do a lot with kind of what's going on with tariffs. And you can see it does track very, very closely the path of the S&P 500 or just broadly domestic equities, where, leading into Liberation Day, uncertainty did obviously increase and increase and increase. And, that corresponded with, the market selling off. And then, as I mentioned, once there was kind of this 90-day pause, a lot of the worst case scenario fears got pulled out of the market. And we did have a pretty significant relief rally through the end of the quarter. And that's obviously continued here as we move into the beginning stages of the third quarter. There is obviously still quite a bit of uncertainty right now, but I think what this really shows is that the worst case scenarios, the worst case fears, do seem to be behind us. We don't exactly know where we're going to land, but it's not, again, the doomsday scenario that I think a lot of people were very, very concerned about. Um, and I think that really dovetails into this nice slide here, because there's always something to worry about. Obviously,
Yes.
leading into Liberation Day, there was concerns that we were going to have 50% tariffs on all of our trading partners, and that was going to lead to massive inflation. There's been obviously in the first half of the year, we've also had, a war almost break out in the Middle East. There's concerns about, Fed independence. It's lots of reasons to be, concerned. And, I'm sure everybody on this call has some sort of concerns. But this is not a new environment, right? There's always something to be worried about. And you go back over the past 15 years, and in every single one of those years, there was meaningful headlines that were making the news, calling for risks, whether it was to the economy or whether it was to stock markets or bond markets or whatever it may be, reasons to maybe not invest, right? But you look on the chart on the right, and what has the domestic stock market done? It's pretty much done nothing but go up and to the right. And so to us, that just kind of says, not necessarily like just ignore the risks, but kind of remember that if you're a long-term investor, the market tends to look through a lot of the near-term risks and focus on long-term growth. So if you are a long-term investor, remembering staying true to your investment plan, not trying to time, oh, I think that there might be a pullback over the next 6 months, so I'm going to try to, time that perfectly. Just stay true to your investment plan. And Chris, I'm sure that you have that conversation very, very frequently.
Yeah, there's some times where sticking to the discipline of the plan is what I even have to do because I have moments of uncertainty where I think, golly, this could be a challenge, or this is a proverbial black swan event. Yeah, I loved it, Casey, when Scott Ladner, the CIO of Horizon, said that I'm pretty sure that at the end of this year, uncertainty will be the word of the year for 2025, right? And so I know that consumers hate the concept of uncertainty. The stock market definitely hates uncertainty. And I'm pretty sure the Federal Reserve is uncertain about what they're supposed to do because they're not sure what policies are actually going to hit. Maybe this whole tariff thing is blowing over a little bit for us now that we have some clarity around what intentions were, maybe. But, and so I think it's, we had talked about how in this next quarter, it's our guess, our hunch that because typically the third quarter is one of the most. Casey, you mentioned this earlier when we were talking that the third quarter is typically one of the more volatile times in the equity markets, and so we had even talked about just on our own as a firm, because as fiduciaries with discretion, we make changes automatically to clients' portfolios. And we had considered the concept of bringing more growth oriented investing. And we're talking about a small percentage, nothing drastic, but just maybe tilting a little bit. And so we just decided that, we're going to hold off for the next 90 days or so just to see if maybe we have some volatility. I think it could be really not too far-fetched to think that the second half of the year would be maybe at least more muted returns with some volatility there. But at the same time, if we're going to add in growth, we certainly don't want to do it when the markets are making all-time record highs. And I think one of the other things that was really important to me that stood out, Casey, when we did our model review, our investment model review, real quick, in case you're wondering, every 90 days, Casey and I do a deep dive into almost every facet of the investment process that we have, how we're investing, why we're doing what we're doing, a good gauge on the economy, and based on our read of the economy, try and make decisions about how to deploy capital from there, how to make investments happen from there. And so the discrepancy, Casey, that you showed me about what the S&P 500 made versus all those high-flying tech names versus the value or the dividend kind of component, thinking of blue chips component, there was what, a 16% discrepancy, I think, between the high-flying growth and the lower-lying, less attractive right now type value oriented names in the S&P 500. So that might be the last time for us to want to add more growth, or who knows, the thing may continue to go, but we're just going to play it a little bit closer to the vest for the next 90 days. And if the markets continue to make money, we'll make some money with them. But it's hard to say. We're going to buy high and hope that it just goes higher. So we'll play it a little closer here for the next 90 days and see how it goes. Casey, that was a fantastic review. I specifically appreciated some of the commentary on the labor markets and whatnot. This slide here that we have up remaining is one of the most significant ones to me because I remember these topics and how in the moment it seems so huge that um, that you would have thought that something significant would have happened with the stock market and the chart on the right, but there wasn't always a correlation. I was actually in a review. I'll leave you with a war story. I'll never forget when Alan Greenspan, who was the Federal Open Market Committee chairman at the time of the Federal Reserve, he went under oath after 9/11 hit, and they decided to just slash interest rates. He came out and owned it. He's like, the Federal Reserve lowered interest rates way too much. They didn't want to diminish the human impact of losing 3,500 people when the World Trade Centers fell. But at the same time, there was not as much of an economic impact. And he, in a part, owned the fact that they set up um, let's say some of the precursors to the great financial crisis and some of the lending policies that came about because of how cheap they made money. And so even there you have a well-studied individual who's responsible for, in a sense, our welfare, basically reading it wrong, right? So he's not alone in that decision. I know there's some other individuals and presidents that would be engaged with him at the different reserve bank locations. But at the same time, those headlines, which would give you so much consternation, don't always play into how the equity market performs. So here's hoping that we don't have more headlines like we've had in the last 6 to 12 months. But at the same time, when the market keeps going up, you just have to be more concerned for some of the people that are maybe negatively affected, but be glad that our investment portfolios keep going up and to the right.
Yep, exactly.
So, all right, anything else for me today or for us today, Casey?
No, I don't think so. I think we covered pretty much everything that we at a high level touch on during our quarterly meetings. So thank you again for having me on today.
Yeah, same. I appreciate the time you spend preparing for this and also the time today. Thanks, Casey. We'll see you again soon.
See you.